Are you suggesting that gold could be banned by the government?
Absolutely. We wrote a piece a couple of weeks ago that actually went pretty viral for us called "Golden Handcuffs." And if you look at it, um, you know, uh, gold is used around the world for money laundering.
Have you ever wondered where your energy comes from? Where does the electricity in your home come from? How would that change? What is the future of commodity investing and cryptocurrencies? And how will the regional banking crisis impact these sectors? We're joined today by Doomberg, in particular, the head writer of the Doomberg Substack. Pleasure to host you, Doomberg. Welcome to the David Lynn Report.
David, congratulations on the launch of the David Lynn Report. Big fan of your work and a real honor to be here with you today. Looking forward to a robust discussion.
Thank you. Likewise, I'm a big fan of your work too. I followed you. You run a very successful, one of the most successful Substacks concerning energy and geopolitics. You've got about 250,000 followers on Twitter, so you're well followed on social media and the internet. But for those people who may not have seen your work or know about you and the collective known as Doomberg, let's get the obvious out of the way first. Why are you called Doomberg, and why are you a green chicken?
Hey, great. Yeah. So Doomberg is a collection of former executives from the commodity sector. We launched Doomberg 2 years ago. We launched it without any social media presence whatsoever. And the old adage in marketing is you can't be remembered if you don't stand out. And so predominantly because we wanted to grow our initial Twitter account with some speed, and also because we're a team and having sort of one person be the face that faces the external world didn't feel right. We created this character, the green chicken. Doomberg is sort of a play on words. A lot of people sort of doom scroll in their lives, and we are actually optimistic people, but we're sort of defensive pessimists. And we were hatched, one would say, at a time where we were coming out of the COVID crisis, but heading into the energy crisis and the supply chain crisis. And given our background in the commodity sector and in complex supply chains, especially in the energy sector, since there are so few people with industry experience actually creating content, blogging, and being a podcast guest, contributing to the discourse for a variety of reasons, not the least of which they have PR firms that stop them, or they have stock grants that they're worried about risking. We occupied that pretty interesting, unique niche of people with relevant commodity industry experience, willing and able to express themselves freely. And Doomberg is the work of a small team that we're super proud of, and it's been truly an amazing run for us. As you list off those numbers, they're kind of hard for us to believe given our humble beginnings, but it truly is validating that it is the work of our lives, and this is what we were meant to be doing. And when you find what you were meant to be doing in life, David, the most important thing is to keep doing it, and that is our plan. So
that is the most important piece of wisdom I've heard all week. So if you take nothing from the interview, remember what Doomberg just said just now. But your success is not surprising for most who have followed your work. You provide excellent commentary and analysis. So we're going to be covering the energy markets today, as well as your outlook on cryptocurrencies. But let's start with the banks, because the regional banks collapsing is a topical issue that affects everybody. I do want to bring our attention to an interview that you've done on another media platform about 2 months ago, where you talked about how you think the banking crisis is possibly over, or on the verge of becoming over, or winding down. Do you still hold that view a month and a half later?
it's hard to keep that view. At that time, we probably ascribed a fair bit more competency to Janet Yellen and the team than they have since displayed. And I would say that Yellen's performance in front of Congress obviously didn't do much in the way of injecting confidence into the markets. And of course, as we both know, banking is nothing more than a confidence game. I would say scheme, but scheme is a bit too nefarious. Banks are built on confidence, and confidence can be eviscerated rather quickly, especially now in the era of social media. And when we said that, it was clear to us at that time that they had let Silvergate, and they had let Silicon Valley, and they had let Signature go, but they seemed to have drawn a line in the sand on First Republic. And with the injection of the $30 billion worth of deposits from the big banks, we felt that it would be impossible for them to let this bank fail. In reality, all it seems that they have done was sort of extend the runway. And then when the bank finally did get seized and the forced sale into JP Morgan occurred over the weekend, that seems to have struck a next leg down in the contagion. Now, as we're recording this, of course, bear markets have very dangerous face-ripping rallies, and all the regionals are up 10, 20, 30%. Pac West, I think, is up 80% today. And so I would have taken the under on the Fed allowing First Republic to fail, and clearly that was wrong. And we bemoan that because in the piece that we wrote 6 weeks ago now called Regional Fallout, we were warning about just how critical regional banks are. Everybody knows this, of course, but we know it viscerally because we live in flyover country and we bank with a community bank. And we actually have a banker who's a person who knows our business, who comes to our office and, is part of our team. And that goes away in a world where we only have the too big to fail banks owning all of the banking sector. And as we continue to consolidate these regional banks into these too big to fail institutions, we're losing a critical part of the economy. Small businesses don't really get the kind of banking they need from the JP Morgans or the Citigroups or the Bank of Americas. They get it from their local credit union or their local regional bank, where they still have, a person they can call. And, this is a very serious issue, one that we were worried about and warned about. At the time when pressed, I said, in my mind, I can't imagine that they would allow this to get worse. And there were simple things they could have done, which they have not yet done, in our view, like substantially raising FDIC insurance levels, in particular for businesses. These funds that are above the FDIC limits, these, generally speaking, aren't individuals that are holding a massive amount of cash above $250,000 in a small bank. These are your construction companies, your design firms, your local car dealerships that have payroll to meet, that have working capital needs, that keep liquidity in these banks above these FDIC limits. And what's happening now, because of the haphazard way in which this crisis is being handled, is everybody, and I mean everybody, is taking a hard look at their treasury strategy. And most small businesses really didn't have to ponder this until today. And, with bank deposits paying below market yields, all of a sudden, when you take a look at your treasury needs and your treasury strategy, the temptation to pull out those funds and put them in money markets or put them in Treasury Direct and only keep the true bare bones liquidity that you need at a bank is pretty high because the yield is pretty attractive. And so it's a combination of obviously bad decisions on the part of leaderships at banks that got them into this crisis. But I would say that if we were grading the response so far, we would give it a D. They're not inspiring too much confidence.
If it's just one or two banks who have made mistakes on their duration mismatches in their loan portfolio and their treasuries, then we could write that off as bad management on the part of one or two particular banks. But it seems to be a larger systemic issue, if you want to call it that. What do you think has been going on such that we have a number of banks making similar mistakes across the board?
So, a mistake in hindsight is easy to call. At the time, all of the pressure is, hey, grab that yield. T-bills are super safe. Now, management 101 of a bank is, of course, you have to watch your duration. And it's not like the Fed didn't signal to the market that it was going to raise rates aggressively. What really happened here is not just with the banks, but I think the market itself is continuously not believing what Jerome Powell is saying. So even if you just look at the sort of the futures curves for interest rates, they've been behind Jerome Powell's curve. And whether it be stocks or, the market for interest rates. And I suspect that perhaps these executives at these banks were taking their cues from the market and not actually taking Jerome Powell literally in what he was saying. But he's been very clear from the beginning that there would be no pivot, that they would break the back of inflation. He would raise rates aggressively. He would say higher for longer. And then the banks that did take the most duration risk, and perhaps had some loose underwriting standards, on top of that, were the first ones to go. But once contagion starts, David, it's very hard to stop it. We tweeted early on in this crisis before, I believe, Signature and even Silvergate went belly up, that bank runs are hard to stop, right? And so the whole bazooka concept of the last global financial crisis with TARP and all of this stuff, TARP worked because it was big enough that it scared people away from testing whether it would work. And we've seen nothing out of the administration that gives any semblance of a branch that people can hold on to say, okay, this crisis is over. Perhaps that $30 billion injection of deposits from the big banks was meant to be a bazooka, but clearly with the failure of First Republic, that bazooka was insufficient. And so unless and until some shock and awe policy change is implemented, I fear that we could see even more contagion.
We are going to talk about Contagion and the effects on other asset classes, but just to wrap up here, do you think, and please evaluate this statement, agree or disagree, do you think that had people not noticed the mismatch in duration of perhaps other oddities in their treasuries and on their books, and nobody had noticed that and bothered withdrawing funds and deposits as a result of worries from those incidents, then none of this would have happened? Everything just would have been fine. Eventually, the problems on the books would have just fixed themselves?
Well, since these are ostensibly zero risk assets, in the sense that there's no risk of not receiving your principal back in return, then of course, I mean, it requires people to run for a bank run to happen. And bank runs are, of course, not always foundationally based on solid fundamentals. But once a run begins, actually, the whole reason why these runs happen so quickly is once you know that everyone else is running, then the speed with which you run matters most. And so this is why this confidence is so critically important. So yes, of course, if they could have held on to those assets to maturity and nobody was pulling their deposits, the mistake was the duration mismatch. The death knell was the social media inflamed bank run that occurred, especially at Silicon Valley Bank. Now look, Silvergate and Signature have this crypto angle to it, which kind of makes them a little bit unique. But Silicon Valley and First Republic were more duration slash, perhaps some underwriting standards and some mismanagement. But absent the bank run, I think they would still be going concerns today. Yes, absolutely.
Interesting. What I was wondering is, like in 2008, when we had the write-downs in mortgage-backed securities because the housing market started to collapse, we saw banks unable to cover their losses, and in some cases, the losses were on par with the entire equity valuation of the firm. What I'm saying is, absent a bank run, would that have happened today?
Right. So the assets that are at issue here, of course, are different. These are treasury bonds that have long duration and good yield and are considered and regulated to be risk-free assets, which is different than the assets that were at play in the global financial crisis 0809. But again, that actually, I think, is the distinction that proves the genesis of the question you were asking, which is because these are regulated. In fact, the banks are encouraged to buy these assets, right? And in fact, as the this is a sort of standard playbook in emerging geographies where the banks are, instructed to buy the domestic debt of the government. These banks were encouraged to do so. Now, look, not every bank did, and some banks managed to see this trap coming and believed Powell and reoriented their portfolios accordingly. And those banks aren't the ones that are subject to the most punishing aspects of this this down leg in regional banks. But they're also, given passive funds and the flows into and out of bank ETFs, they're suffering as well because there's forced sales, because as people pull their money from these ETFs, all of these flows can cause crises that then morph into a self-sustaining one. So you could have a perfectly good bank that made all the right decisions, but its stock might fall 30, 40, 50, 60% because it is a prominent member of an ETF that is experiencing outflows, as you know, like sort of the Mike Green catastrophe warnings of the past couple of years. And so then people might begin to question, wow, my bank, which has made all the right decisions, its stock is down 60%. Maybe I should pull my funds. And that's the kind of contagion that I'm talking about, where it's not just whether, if they had been allowed to actually hold those instruments to maturity, would they be fine? Really good banks that have solid balance sheets might also get caught up in it because of the disease of contagion is very contagious, and that's why it's called contagion.
Speaking of contagion, do you see any other assets that perhaps you cover that are at risk because of these bank failures?
Well, that's the thing about bank failures and contagion and the global financial crisis of 2009. We were all told, and many believe, that subprime is contained. But as you know, in a crisis, you sell what you can sell, not what you want to sell. And so in a true crisis, the correlation of most risk assets goes to one. And so we see these random strange sell-offs in oil, for example, and I know we're going to talk about energy. Maybe that's some bank that needs to raise capital that has a liquid position. This is very chaotic in the scientific sense, sensitively dependent on initial conditions situation where, you might see a rapid sell-off in an asset that you would think would be doing well in this environment, but it just happens that an institution or a shadow bank or somebody involved in the credit markets is in need of raising capital, and they sell what they can sell, not what they want to sell. And you see these weird moves, like we saw in oil earlier this week, a strange, bizarre, out of the blue, unsupported by the news flow, massive sell-off in oil that has since recovered. Who knows what the genesis of that was? It certainly didn't appear to be at least supported by the fundamentals.
Okay, well, let's talk about oil fundamentals and then energy at large. I've been hearing comparisons to the future of energy to the 1973 oil crisis, such that we may have perhaps a slowing economy, but a huge spike in oil. Is that something that you've looked at, and is that an outlook that you agree with necessarily?
I would say that anytime that OPEC or OPEC Plus in this case has market power, historically, the evidence is that they tend to use it. And we saw that when they did the surprise 1.5 million barrels a day production cut several weeks ago, much to the chagrin of the Biden administration. You'll notice that suddenly the Biden administration is now also emptying the Strategic Petroleum Reserve, not at the rate they were last year, but certainly at a rate that is noticeable by the market and is being noticed by the market. Inelastic commodities like oil are sensitively dependent on flows of demand and supply, which is why they're inelastic. And it doesn't take much either way to tip the scale, which is why you end up with minus $37 a barrel oil and $130 a barrel within 18 months later. Right now, I would say that we are still structurally bullish oil, and then natural gas, of course, is extremely regional. And to the extent that natural gas is produced in association with oil, as we have it here in the Permian Basin in the U.S., you could see a glut of natural gas in certain regions, which is something we've written about recently. But oil in particular, it seems like OPEC has decided it will attempt to put a put under the price of oil around $65 to $70 Brent, and we shall see whether they have the discipline to keep cutting production in the face of potential economic disruptions. And this is tied to the banking crisis, of course, because to sort of square it all together, if small banks lose deposits, small banks stop lending. If small banks stop lending, the economy comes to a halt. And if the economy comes to a halt, the demand for oil and these commodities, of course, will slow. And so whether OPEC Plus has the ongoing discipline to keep their market power by not overproducing remains to be seen. Historically, that it's a mixed bag, to be totally honest with you. They seem to be more unified than they have been historically. We wrote a piece called Uniting States to this effect, where China is trying to broker sort of a broader peace in the Middle East and Russia. And if they're successful and they sort of unify OPEC Plus and they have some cohesion, we could be in a very interesting, essentially stagflation where oil prices remain high and the economy struggles.
Let's back up for a minute. How impactful today still is OPEC Plus on the overall market of oil? Remember back in the 70s, we did not have fracking in the U.S. and the United States was not a major oil producer. And so do you think that their power overall on the market has waned over the last 4 decades?
I would say their power was very strong until the shale revolution, at which point the U.S. became the swing producer and the major source of growth. The U.S. has not yet recaptured its pre-COVID oil production levels, and there are many questions about whether they can, especially with the rate of depletion in the oil patch. And ultimately, as Lou Gehrig says, all of the incremental growth of oil in the world comes from 6 counties in Texas. And if those counties roll over in production, where's that incremental growth going to come from? So there's no question that OPEC Plus is still a substantial player in the oil market. And in particular, if the U.S. Is no longer the sort of swing producer, that source of excess growth, and if the U.S. Oil production begins to turn over, because don't forget, at lower oil prices, which is what Biden wants, and at higher interest rates, which is what Jerome Powell wants, the motivation to invest in the oil patch in the U.S. drops substantially. And one wonders whether even at these prices, down to 65 this week, back to 71, 72 on WTI as we're recording this, at these prices, is it truly incrementally profitable, especially given the cost of capital for that incremental driller to go ahead and do it? And if it's not, and if U.S. production rolls over, then yeah, OPEC Plus becomes basically the key player that determines whether, if they have discipline, the prices go up, and if they don't have discipline, then prices go down. But the decision will no longer be in our hands; it will be in theirs.
I think just for the average layman watching this who may not even be an investor, he's probably wondering whether or not his gas price is going to significantly change by the end of the year, all depending on the economic conditions. So what's your view there?
So gas prices, of course, have an additional parameter, which is the availability of refining capacity. The U.S. has woefully underinvested in refining. And in fact, in a piece we wrote recently. Um, the New York diesel crisis was abated by diesel, which was imported from India, and India got the oil that it used to refine to make diesel from Russia. And so Russian oil effectively was used to abate a northeast, New England area diesel crisis. And that those molecules found their way through Indian refineries into the U.S. Northeast. And so these are complex markets and not really amenable to sort of simple headline analysis. But I would say the risk of having high gasoline prices or diesel prices in the U.S. is not just the price of oil. It's also the availability and the efficiency with which such products can be refined into those final products.
I was seeing headlines last year about a significant diesel shortage in the United States. Is that something you looked into, and is that even a significant problem anymore?
Yeah, well, again, as we just mentioned, 40% of the imports into New York in Q1 were from India. And the molecules that we imported from India originated in Russia, which makes a mockery of the sanctions, of course, which is a whole other discussion. So yes, this is truly, the US has not built a major refinery in 40 years. If you think about the size of the economy and how much it's grown in those 40 years, it really is amazing that we have not built a new refinery in this country in 40 years of significant scale. And in fact, our refining capacity is flat over those years. So we've had some expansions at some of the bigger refineries, but we've also lost a fair number of the smaller ones. And so again, the price of oil is an input into refineries, but on top of that, you have to look at the crack spreads to see what the average consumer is going to pay. Now, to Joe Biden's credit, he is acutely aware of the price of gasoline and what it means for his political future. And last year, when gasoline hit $5, $6 a gallon, he panicked correctly, intelligently, released the oil from the Strategic Petroleum Reserve, which may or may not have been the right decision, but at least he recognized that his political future was at risk and tried to do things to abate the situation and succeeded. Not only did the price of oil come down, his party outperformed in the midterms, and those two things are definitely not uncorrelated.
Well, the American net crude oil imports have been coming down ever since the mid 2000s, precisely because of fracking, like we talked about in shale. How would you rate the American energy independence policy that I know the government has been trying to pursue for several decades? Are we there yet? Full energy independence?
So it depends what you mean by independence. We produce on a net basis as much as we need, but we do not produce the right kind of oil that our existing refinery fleet needs. And so, as I'm sure you know, we export a lot of oil and we import a lot of oil because of that refinery mismatch. And so, to the extent that we are still, quote, dependent upon those imports, we are not energy independent. Having said that, the people we are trading with, of course, ultimately, in one way or another, are dependent on our exports. The U.S. is the world's largest producer of fossil fuels, oil, gas, major producer, especially natural gas. And so we are a energy superpower. And the mechanics of how we actually balance, the specific molecules we need, we should be aware of those. But I would say, by and large, we are roughly energy independent today, as long as free trade is not interrupted.
Speaking of oil and vehicles, the United States military wants its entire fleet to go electric by, I think, 2035. Can you comment on this and whether or not this is a pipe dream or a reality?
It's a pipe dream. We wrote a piece to this effect. We had some fun with Jennifer Granholm, who reiterated this insane policy stance in front of Congress. And we just did a hypothetical of, what's the battery size of an Abrams tank, and it's clear, of course, that the military will first start with their non-combat fleet and, the trucks on the U.S. bases and things like that. But really, if you take it to the extreme and you really wanted to electrify the military, what would that look like? And we show just how crazy it is. Ultimately, this all reduces down to the massive energy density advantage that a gallon of diesel has over, a battery pack. And as any engineer would know, give me energy density and I'll win a war. War is nothing more than the efficient conveyance of destructive energy upon the enemy. And if we're really going to worry about climate change impacts of war, then we're not really worried about winning the war. And so we do believe that this is political fun talk and truly deeply unserious.
I'm no military strategist or expert, but presumably on the positive side, suppose we did have an entirely electric fleet, the supply chain issues of transporting oil across the battlefield may be solved. I don't know.
Well, how do we transport electricity across the battlefield to recharge these things? And
True.
the supply chain challenges, if you want to talk about supply chain, at least we produce our own fossil fuels, as we just mentioned. Um, 90% of the battery and electric motor market is controlled by China today. So we're going to give up a fossil fuel based military where at least we have a strategic petroleum reserve. Half of it is still left, and we have domestic refining and domestic production that we could certainly ramp up pretty quickly if we wiped away the environmental constraints. We do not have the rare earth metals or the rare earth metal processing for the magnets that go into the motors. Most of the battery supply chain and the metals that go into it are controlled by China. We're trying our best to make up for that. But if you were to tell me who owns the supply chain on oil versus on batteries and motors, China has no oil and gas, and to speak of, and they own the battery, they own the solar, they own the wind, they own the entire critical metals and refining for those so-called green energy transition materials. And so from a national security perspective alone, forget about science, forget about climate change. In the narrow lens of national security, this would be a catastrophe. And I do think that saner heads will prevail in the military because this is just literally, it's so silly that it's amazing to me that we're talking about it.
Okay. All right. Well, on that note, let's talk about electricity generation. Suppose we do have this greenification take place and this trend actually being enacted. The question is where the electricity will be coming from. And I'm looking at this chart. It's dated as of 2 years ago, 2021, from the EIA, the Energy Information Administration of the U.S. And I'm just going to break down the numbers for you, Doomberg. You're aware of this already, but just for the audience, I'll put a chart up. Renewables, 20% as of 2021. Nuclear, 19%. Coal, 22%. Natural gas, the remaining 38%. How do you think these breakdowns will look like 20 years from now?
My desire would be that we would see substantially more nuclear if we're going to decarbonize the grid. I think nuclear has the right combination of high baseload potential, materials that we can control and safe and cheap. Solar and wind, of course, come with the challenge of intermittency. And so in reality, the numbers for the rest of the sources that you quote would be much higher, except they have to make room for wind and solar when they're on because you have to do something with that electricity. And most importantly, you can't actually retire the baseload capacity of your grid because when the sun doesn't shine at night and coincidentally the wind doesn't blow during times of relatively timid weather, the grid still needs its capacity to be filled. And so what you see in countries where you have significant penetration of wind and solar is, in fact, you have to create a completely duplicative system as backup power. Watch Germany in the next 2 years now that they fully exited nuclear. It's going to be fascinating to see. I hope we learn the right lessons from Germany. But in our view, the grid should be anchored by nuclear power, which has a capacity factor in the 90s when well run. But unfortunately, we have to sort of play this little song and dance on renewables because that is the politically popular vernacular of the day.
Certainly, you've done some blue sky thinking, which is to say, have you considered some alternative energy sources that are still possibly in the realm of science fiction today, but may one day be a reality? I'll give you one example. So I'll let you comment on this and perhaps some other examples you have. A couple months ago, there was a breakthrough in cold fusion. For a very brief billionth of a second, they produced energy using cold fusion. And for the first time, they produced more energy than was needed to input to create this energy. It's not commercializable yet, but
Sure.
It could be one day. I'll let you expand on this.
So, small correction, it was distinctly hot fusion. Cold fusion is a widely believed to be a fraud from a couple of decades ago, where they claimed to have been able to achieve fusion at room temperature. I just want to make that small correction. But you're talking about fusion in general in this particular case. We would argue that fusion is interesting scientifically, but unnecessary. And in fact, fission, which is the process behind the nuclear power that we have today, if fission were invented today, it would be hailed as a civilization-saving invention that we should drop everything we're doing and implement post haste. We have within our hands today all of the technology we need to produce more than enough energy for all of our needs. The challenges with fission today are all political. They're not scientific, and they're not even directly financial. The financial challenges with nuclear today are as a result of our politics. The radical environmentalists have proactively set about trying to destroy fission, and they have succeeded. To give them full credit, they are very effective at doing so. With a clean slate of paper, we do not need blue sky inventions. We have everything we need. The energy payback period on fission is 6 weeks. We could totally recalibrate our energy infrastructure around a nuclear renaissance and create more than enough abundant energy for the entire population to enjoy and to improve their standards of living with. So fusion, in the eyes of the true nuclear fans, is viewed as a distraction from the answer we have in our hands today. I think fusion is very interesting scientifically. In a world where fusion worked, the environmentalists would oppose it for the exact same reasons why fusion is opposed, because it works.
We're seeing China and many countries in Asia actually wrapping up production of or construction of new nuclear power plants. So certainly their policy differs from the West. Why do you think that is?
Because it's the correct answer. And one thing that the developing world learned from Germany is they watched what they did in this last energy crisis and stopped listening to what they're saying. They returned back to coal on a moment's notice because they needed to after having shut down the nuclear power plants. And so the emerging economies are not going to care about climate change. They're going to design their own energy policies for their own domestic needs. And we'll see what our response is. But China, India, nuclear, coal, Indonesia going back to coal, Pakistan, which had bet its grid on access to liquefied natural gas, that went away because Germany outbid everybody for it heading into this winter. They are returning back to coal. Baseload power is the dominant parameter. Carbon emissions are the second parameter. And so through that lens, nuclear makes sense. And then secondarily, if you don't have the technical sophistication to do nuclear, coal is very attractive to these countries and they're going to go for it. Because why wouldn't they? Germany did. Germany brought back coal. They retreated to the coal mines with the speed and efficiency of the evacuation of Dunkirk at the site of a first crisis. And the countries around the world watched that. And Germany lost a lot of credibility in this regard. But it's not just China and India, by the way. Canada has done an about face on nuclear power. Justin Trudeau has made some very positive comments. We're writing a piece on that soon. The U.S., Gavin Newsom saving Diablo Canyon, significant incentives in the Inflation Reduction Act for nuclear power. We just had a new nuclear reactor go critical in Georgia for the first time in the U.S. in many, many years. Outside of Germany, the world is realizing that physics matters. And when you use physics as your lens, nuclear is by far the best measurement across the options available.
All right, I want to switch gears and end on crypto now. So pivot into a different asset class. Fed pivot is a topical term, so I was using a pun there. But anyway, I found it funny. Okay, so cryptocurrencies, what's going on with the regulations? Why are all these exchanges getting sued?
I think that it's very clear that the U.S. government, SEC, U.S. Treasury, you name it, wants to control crypto. Wants to implement full know your customer anti-money laundering into the crypto space. And they're setting about the task of ejecting non-KYC AML out of the US dollar system, period. And they just are. And people who think that they aren't, I think are in denial. I think a year from now, there will be two cryptos. There will be whatever's left of crypto in the US dollar system. And to participate in that walled off system, you will have to be fully KYC AML compliant. And there will be an outside of the US dollar system crypto, which will be a free-for-all. And the objective of the US government is to wall off the US dollar system from that free-for-all. And I believe they will be successful. And the big question is what happens to Bitcoin in that world, because it will be one of the few assets that straddle the two. And so we shall see. But I do think it's very clear that Gensler is acting in collaboration with the CFTC, and the U.S. Treasury. The CFTC charges against Binance were an amazing document to read. It's very clear that the U.S. government has insiders at these places. They have devices. They have extracted an enormous amount of data out of Binance's operations to be able to charge them with the specifics that they did. Very curious to see how this this battle between Coinbase and the SEC evolves. Coinbase has taken a very interesting legal strategy, to say the least. But I think a year from now, the crypto universe will look really different, and the action will not be happening in the US dollar system. It will be happening offshore. And so for Americans, you'll have a decision to make. But that's clearly what's happening, agnostic to whether or not we believe that's what should be happening. It's very clear that that's what is happening.
Well, let's comment on whether or not you think the direction that the regulators are taking is correct, in your opinion. I do know that last year, when we had a string of failures in the crypto industries, namely Celsius, FTX, even Luna,
Sure.
there were calls for regulators to do more. And so they are doing more right now. The question is whether or not doing more now is going to help fix some of the issues that we had last year and prevent a repeat of FTX.
So it depends on your goal. If your goal is to develop a market for assets that are out of the reach of government and their surveillance, then you would view that this set of activities by the government as bad. If your goal is to maintain control over money and the power that comes with it, and the US dollar eye of Sauron, as Ben Hunt calls it, then their behavior is both very predictable, and also if you think that that's a good thing, then you should cheer it. We're sort of two minds. We certainly understand the desire to have privacy and to have assets out of the reach of the government. And we wrote a piece saying gold could be next, and the gold bugs cheering the crypto crackdown should be careful what they wish for, because the exact same tactics could be used against people who own physical gold in their private lives. And also those tactics are dangerous precedents. Being ejected from the banking system simply because you work in the crypto space is a very, very dangerous precedent. And so we are conflicted internally. It's utterly predictable. We've predicted from the beginning of Doomberg that this would happen. At the same time, it's dangerous and makes us uncomfortable. We're no coiners. I've never owned a cryptocurrency. That doesn't mean that we don't observe it and study it and are interested by it and understand the rationale for many of the people who want to own Bitcoin in particular. But it does pose very hard questions as a society around privacy. Who controls money? Is money a public good or a private good? It's very clear that the U.S. government has decided that they've had enough, and they are cracking down with violence. And so it's fascinating to watch as an outsider.
Well, I just want to touch on this real quick before we end. You said that what they're doing to crypto could be done to gold. Are you suggesting that gold could be banned by the government?
Absolutely. We wrote a piece a couple of weeks ago that actually went pretty viral for us called "Gold in Handcuffs." And if you look at it, gold is used around the world for money laundering. Once you commingle gold and resmelt it, it's not like you can you determine where those atoms came from. A gold refiner today is the physical equivalent of Tornado Cash, if you know what I'm referring to, which is these crypto mixers. And gold, all of the things that are being crypto is being accused of, happens in the gold market all the time. Money laundering, failure of KYC, AML. And in fact, if the government wanted to create a propaganda campaign around why they should outlaw gold ownership again in the US, by the way, it's not like there is no precedent. Gold ownership was outlawed for decades. Here's what they would say. Gold owners are rich tax cheats. Gold owners are Putin sympathizers. Gold owners are unpatriotic. Gold owners are being well compensated for turning in their gold, because we're going to pay you to turn it in and come clean. Gold owners represent a national security risk, and gold owners enable organized crime. The exact same accusations against crypto could credibly be made against gold. And this is why the tactics that are being used and the precedents that are being set should still make people uncomfortable, even if they are anti-crypto, no coiners who are convinced that the main use case for crypto is crime. Those people shouldn't allow the government to take away people's rights without due process, et cetera, et cetera. And this is how we've tried to sort of straddle the line. In a way, we end up annoying both sides. But we can be a no-coiner and still see the danger and the precedents being set. And if we wanted to help the government write a propaganda story around banning the private ownership of physical gold, it's very easy to do. And this is what we outlined in the piece.
Ultimate question, Doomberg. So in light of everything we've discussed, geopolitical risks, developments in the energy market, regional banking crisis, what should people do to protect your wealth? And I think this extends beyond just banking, because if you take your money out of the bank, the obvious question is, where do you put it? right? So I'll let you answer that from
Sure.
both sides.
I can't tell people what to do in their own portfolios, absent knowing, the full 360 of their assets and their needs. I can tell you what we do. We earn money and participate in the fiat world. We save money by buying real assets like gold and land and so on, and collectibles. And we invest privately where we can have a direct impact on the outcome, because we believe that our skills and knowledge and networks can add alpha in a way that investing in the public markets does not allow. We're not good at it in the public markets. We're better at it in the private markets. That's what works for us. Now, I've said this before, and many people on Twitter ridicule us. We earn money and participate in the legally regulated fiat world. If the US government said tomorrow, I live in the US, that the physical ownership of gold is now illegal, I would turn in my gold. So I'm not going to break the law. I will argue that that's a bad law, but I'm not going to be behaving outside of the law. I have a family and I have a good life and I have friends and a reputation that I would like to preserve. And the possession of the gold that I own is not more important to me than abiding by the rules and regulations in the country that I currently reside. And I think those statements are not, at odds with each other. If the U.S. outlawed the ownership of Bitcoin tomorrow, Bitcoin owners would have a decision to make. Is the ownership of their Bitcoin worth going to jail for? I can say that the ownership of the gold that I currently have is not worth me going to jail for. And I'm not ashamed to say that. I would work politically to try to overturn that. But in the intervening period, if something is overtly illegal, I am not going to do it. And that's just the way that, so in a world where my gold collection is to be confiscated by the government in return for some form of a fiat payment, I would have to then take that fiat and put it into some other hard asset that I use as a saving mechanism, like collectibles or land, or pick your favorite. And so people like to talk tough on Twitter about, this is my Bitcoin, or I would hold my gold. It's a real interesting decision when the government is looking at you saying, are you willing to break the law? Most people aren't. We're not.
I stress the term collectible, which is what you used, and not your entire life savings, because people have been talking about pulling all their money out of banks because of the banking crisis into some sort of other hard commodity or asset as an entire form of savings. But that's not what you're doing.
No, in fact, in a world where, I have an account at Fidelity,
Right.
In a world where Fidelity is in trouble, my wealth is going to be measured in the number of beans that I own and the number of bullets I have to protect it. I mean, and who wants to prepare for that eventuality? At some point, you have to operate. That's why I say we operate in the legally regulated fiat world, and in a world where J.P. Morgan and Fidelity are having solvency issues, you got bigger problems, David, than how many ounces of gold or how much Bitcoin you own on a flash drive.
That's a fair point. Well, the producers of The Walking Dead are always preparing for that eventuality. But besides that, you're right. I agree with you there. Thank you very much, Doomberg. And where can we follow your work? What's the best way to, learn more from you?
Sure. First of all, thanks for having me. Congratulations again. Doomberg.substack.com is where all of our work is. We publish 6 to 8 pieces a month on energy, finance, and the economy at large. All the topics we talked about today. It was a real pleasure, and enjoy the rest of your week.
Thank you. You too. And have you ever considered changing your avatar?
No, we love it. It's who we are.
I wanted to end on this. Is the color green because you like nuclear?
No, the color green is because we love our Bloomberg keyboard, and it's we love Bloomberg, and we're big fans of the product. We're super users, and so it just gives us a good, warm feeling every time I look at my Bloomberg. If you've ever had a Bloomberg. It's the single greatest product in the world, no matter how much they charge for it. And we love it. And every time I look at my Bloomberg keyboard, it makes me smile. And every time I look at the green chicken, it makes me smile.
Excellent. Well, you certainly made us smile today. Thank you again for your time. And we'll keep in touch. I'd like to have you back on again.
Thanks.
And for the viewers, thank you for watching. Don't forget to subscribe.